Welcome to an urgent discussion about the $5,600 gold signal. This isn't just a commodity rally, it's a sign of a massive industrial reset. If you're only watching the gold and silver ticker, you're missing the most critical business story of 2026. The surge in gold to $5,600 per ounce and silver crossing $120 is more than a safe haven trend. It's a deep macroeconomic signal. This commodity rally is the scorecard for a huge economic experiment, the manufacturing mandate. Leaders, we must look past the spikes. The first structural shift is the weak dollar growth bet. The US dollar is at a 4-year low, and this is by design from the administration. A softer currency has been explicitly signaled to enhance export competitiveness. The primary goal is to make American goods cheaper globally, stimulating industrial production and manufacturing jobs. The risk? We're battling, quote, tariff-driven inflation, which complicates the Fed's ability to cut rates. Businesses must navigate a high-cost operating environment. Next, let's look at the divergence between the efficiency economy and broad job creation efforts. While macro policy pushes for industrial hiring, positioning manufacturing for export-led growth, corporate reality is quite different. In the tech and corporate sectors, major players are doubling down on efficiency, executing significant restructuring to preserve margins. Despite economic stabilization efforts, job gains remain, quote, low overall. The lesson for 2026 is that growth will come from optimization, not just headcount expansion. Finally, we examine the value over volume retail shift that the gold market is reflecting. The bullion market is a microcosm of the wider consumer economy. Jewelry sales in India saw huge revenue growth, but this was almost entirely price-led. Actual sales volumes declined as consumers adjusted to higher costs. This reveals a critical pivot point for retail strategy. Smart businesses are pivoting to commercially efficient assortments and digital products, rather than relying on volume stockpiling. With central banks buying gold to hedge against instability and analysts suggesting $8,000 by 2027, the high-cost environment is structural. This high-cost environment is structural, not transient. It's the new normal for global business. My key question for all leaders: are you positioning your business for volume, betting on a demand surge, or value, optimizing for higher margins and efficiency? The data strongly suggests that 2026 is the year of the latter, the year of value.